Good morning. This is the Eye of the Storm podcast, the big picture update for Sunday, February the 5th, 2023. Today we'll cover the SPX, the NDX, the Treasuries, which include the 30-year bond, the 10-year, 5-year, and 2-year note, gold, silver, and the dollar index. I am publishing this on Sunday morning mainly due to the fact that I did part 2 of an additional podcast with my guest, Dan Ascani, yesterday on Saturday. So I was unable to publish twice in one day, just due to the work that's involved. In any case, let's begin. I'm going to start with the SPX, or the equity cash markets, and just a little bit of a review. Last week was a very interesting week. The market continued to move higher under what at that time I was counting as an intermediate wave 2. As I got ready to do this particular update, I came in, and the one thing that I continued to have to leave open was the potential that both the S&P and the Nasdaq may have not reached their completion points for that, at the time, intermediate wave 2. So I started to look at what it would take for if I had moved over. So I wanted to show the labeling if I moved over that primary wave A, and was realizing that the market may be in this primary B wave still. But as I was in the process of doing that, the market, or the charts, basically showed me pretty much what is likely going on. And when I was studying the count, and I had moved over that primary A, and I thought, it just again doesn't necessarily feel right. And so I went back and I looked at some of the internals for marking the June lows as primary wave A. Now, granted that it had come down and in an intermediate ABC, but then I felt for the longest time that this may have been a rushed count, but it continued to hold and continue to produce what I felt were the necessary moves until we got here. Everything was fine up until we started to break higher off of the mid-December lows. That started to change the whole potential for what I felt was going to go on. And primarily, it continued to hold within an intermediate wave 2. But the sincerity and the push was all premised by that the market had priced in a 25 basis point rate hike, which we did get on Wednesday. And then again, what happened on Wednesday is that the Fed statement as issued, the Fed statement, the written statement, to me appeared to be more hawkish. And then when Mr. Powell stepped up to the mic to do his press conference, it just turned into something totally different. And I thought, wow, you're hawkish on this side and you're being more dovish on this side. And it just seems that you're pandering to something. And in fact, Powell made mention of a robust employment market was robust. Now, I have to believe that on Wednesday, before they made their final decision to only do 25 basis points, that they had the information that was going to be presented on Friday for the employment situation. So this talk of a robust jobs market, I was like, okay. I knew ahead of time that the consensus, as reported by Econoday, was that there would be like 250,000 new jobs, or people, finding jobs, going to work. And then when that number came out on Friday, it was over double. So it came in over 500,000. And that surprised me. And it also then brought about a situation where the market immediately reacted and dropped strongly right off of that number. And why? Again, as I constantly try to explain, the fact that over 500,000 people are back to work or have new jobs, are not going to be unemployed, is a great thing for us as human beings, and basically almost as a country. People are going back to work. They're going to be able to afford their homes, their rents, their utilities, buying food, supporting the families, etc., moving forward. But what it does produce, we're already in a period of increasing inflation, slightly decreasing due to a couple of factors within all of those numbers, but still. And we also had a Fed that was basically saying that inflation is continuing to be a stubborn problem, and that there would be, for the foreseeable future, a continuation of rate hikes. Now, the market initially thought, whatever, and they went up on Wednesday after Fed Chair Powell stepped to the mic. They liked it. They took the market higher. They again then took the market higher on Thursday. Friday, we drop. But come the opening, the stacked orders, the pre-market orders that were all put in, were favoring heavily to the buy side. But as I noticed within the Nasdaq, it primarily was the same suspects, the usual suspects. And it was Apple, which actually had reported also on Thursday. So also on Thursday, we had Apple, Amazon, and Google, the trifecta, as I called it, of reports come out. All disappointing. Apple clearly saying, we don't intend, or we don't foresee of having making as much money due to the economic conditions, due to what is going on, due to the possibility of the country moving into a recession, et cetera, et cetera. Amazon, same story. Google, same story. Apple was closed on Thursday during the after hour, closed lower, closed about $4 below where the market closed. And Apple, I believe, on the Thursday had closed regular session at about 150, which was the major strike that carries the highest open interest going into Friday's expiration. Well, the first thing that Apple did to do on Friday morning, against the backdrop of not good for inflation employment situation numbers, they just start beating the door down and pushed Apple up above 150. Now, the other two stocks that I noticed that were really in play were Meta and Tesla. Meta going up because during their earnings on Wednesday, Metaverse announced that they were going to do a $40 billion stock buyback. Boom, run the stock. Tesla has just been on a tear all by itself, just on a tear. And it has been massively wrapped around the weekly expiration. And in this case, for Friday, it was pretty apparent that they were going to gun for 200. In fact, it was also apparent that Metaverse would gun for 200. Now, those two companies, their stocks were totally being controlled by the options expiration, and it was being wrapped around 200. 200 in both stocks. And if you went and looked at those open interests coming in on Friday, you could see why it was wrapped around 200. Metaverse did not get close. Tesla got within $1. Nonetheless, that did not occur. Both of those stocks closed well below 200. So expiration came, expiration went. Back to me just doing the count in the cash markets and also in the futures markets, which I will talk about later on today when, after Globex begins, I will do an Elliott Wave update for those two markets. Now, again, so I started to take a look. And first thing that I did is I changed what I thought was a ABC and then a primary B. I dropped it back down and figured if I have to drop this over to if this was going to be primary A, this had to be an intermediate C wave, which then in case this could not be an intermediate anything because I have ABC, this would make this an intermediate A wave. And then this couldn't be a B wave because it was 5. So I started to have problems shifting it over. Then I went back to like, okay, this is 3 waves up. And it's ending up, so I marked it X. And this is A. This gave a much cleaner B. In fact, it gave it a little bit more room should they decide we're not done yet. And then a C wave down to complete wave A. Because the other thing that I've been noticing is that the market's resilience to hold itself up versus allowing the next sequence to begin, which tends to tell the analyst something is up, something may be up within the count or just, within how this is all playing out. So I labeled it as thus. It does not necessarily change anything about our current structure, what the market still has the ability to do to the upside. And once the downside does begin, it just still has that same target initially of below 3,500 and then on down to fulfill an intermediate C wave. And then, folks, it could possibly be just the primary A, which again sets the stage for a powerful B wave counter trend rally. It just is not going to be on a cycle degree. It will be on the primary degree, but still powerful, still move quite quickly, still have the ability to possibly go to new all-time highs should it turn into an irregular B wave. So all of the after effects remain in place that we're setting up. Once we can get this now likely C wave done, first of all, we need to get this B wave complete, which would have been marked intermediate wave 2. So even if I run both of those side by side, we're still getting the same thing. If I'm looking for an intermediate third wave, that still would be expected to drop below 3,500. And it still would be expected to drop down to 2,880 to 3,000. So whether it's a C wave or a third wave, it carries the same potential to take us to the same area. So I'm going to leave this as is for right now and call it an X wave, which does give a little bit more room if the market isn't completed this secondary, or what I will label as intermediate wave B, and then flip as our alternate view, the intermediate wave 2. I will run them side by side as I've done before, but I'm more comfortable now with the fact that that primary wave B, in my view, was always small, was too small for what. So, and if you remember, one of the things I constantly comment on is don't be in such a hurry to label. Everything is complete, and now we're going to do this, and that's going to be a bigger move. Because even if it was a primary B wave before, if this would have stayed intermediate wave 1 and we were completing intermediate wave 2, it could not have gone above 43.27. And in this case, on the cash market, 43.25. It could not go above it. And yet we had broken, well, in the futures market, we broke above. We didn't in the cash, got close, but we did not break 4,200. Now, what can I look forward to coming forward? We have to leave open, and this is the weekly, so let me drop down to the daily chart and we can see the internals. You can see we've got this, what can you can really look at it and say, well, it's a log jam type of a move. And that is where we have two strong up bars, the next one reaching for a new high, and then a bearish engulfing. So that's what they call a log jam. And it normally will be signaling the end of this upside and the start of the next move lower. So, but I need to keep open the potential, right? If we're counting a C wave up, and we've got 1, 2, 3, 4, we may still be inside the fifth wave. So again, then I come down and let's take a look at the hourly. Actually, let's take a look at the 4-hour chart. So we got 1, 2, 3, 4, right? So that fourth wave comes down to the January 30th low. Now I can go down to the 1-hour chart. So we got our marker. We're looking for January the 30th, 19th. That's going to be right there. So here we need to count up 5. 1, 2, kind of looks like only 3. 1, 2, 3, ABC 4, right? A, B, C. So we need to leave open the potential that, yes, the S&P can go up and make one more drive to get itself up. Now, let's start putting in Fibonacci's. The first one would be, we now can just run retracements, as I did before, measuring intermediate wave 1. Now I'm just going to measure wave A, compare it to wave C. Wave B. So what we have is 40.79, and our next up is basically coming up and having a flat, ABC flat. And that takes us up above 4,300. So we still have the possibility. I'm going to add one more, and then we're going to fill in this hole right here. And that's going to be, we're going to run the extensions for wave C. That one did not. So I'm going to go here to here. So here we have, it hit it on the nose on Friday, but what we have above is 42.43. That remains possible. So the cash at 42.43. And then again, for an absolute flat, 43.25. If it turns into an irregular, we're going to skyrocket. We're going to move strongly, because then we're jumping up into these levels. In the current environment, with those employment numbers coming out on Friday, I don't necessarily see that right now. But I can see a stab at getting above where we were on Friday and finishing whatever's going on in Tesla, Meta, and some of the stocks. So again, if it's going to be played out against the fact that those numbers were a surprise, that employment situation was a big surprise. The market reacted, but then on the opening, they jammed it higher based on the influx of capital into 4 or 5 stocks. Now, if that's over and the selling picks up, and again, tomorrow we will see, because again, all of the orders that'll be stacked up, everybody coming out of expiration, how do they want to look? What do they need to do? And then again, what the hedge fund managers, the larger players in terms of the ETF asset managers, what are they seeing? What, how's that money coming in? Are they redeeming? Are they getting out of those ETFs? Are they starting to sell, et cetera, et cetera? So we'll find out pretty quickly. But if we need to leave open the potential that it could come up this high. Now, outside of that, right? So what we have in terms of just where this B wave can go, it can go up and be a flat. So it can get up in here, can get even closer, and still be an A, a B, and then we do a C wave down. If it gets up close to being a flat, then essentially, folks, we really wouldn't be looking for much more below 3,500 in terms of the C wave. And what the whole thing ends up being here, back out to the weekly chart. Let me take these off now. They get in the way, and then we can't see what we're doing. The whole picture turns into an ABCX ABC, a double ABC, which I've now come to realize by many who are followers of Elliott, label as a WXY. Now, that still may be what they use. That's not found in Elliott's writing. It's not even found in any of the updates of the Frost-Prechter book. So it's valid. I'm not going to say it's invalid, but that's what it would be. And it's just a different way of saying a double ABC. And what a double ABC really notates is that you get an ABC, an X intervening, and then another ABC. So right now we've got the A, we're finishing up the B. It may already be complete. I'm just not labeling it as such. And then we get the C wave down. That's going to be labeled primary wave A. And then we get the start of, again, it's just changing. Yes, it changes the size of this B wave, but not the potential, not how that B wave will unfold. It's still going to be a strong counter trend rally. But the other thing I have to tell you, and I'll be showing you this as I move out, which I'm going to do right now, is that how now changing this and with now coincides with what the bonds look like they need to do, what gold and silver are likely doing, and what's the dollar's moves. So suddenly, by just flipping things around and filling in the counts on the other sectors or so sections of our economy that I look at, it seems to be in alignment again to all support one another, the different areas in the moves that are appearing apparent. And now be talking about that. Let's go over to the Nasdaq. Before I go, you can see moving average wise here. This is on a weekly chart. Things have really gotten flat. The 50's flat, which starts to tell you that, we're on the weekly, we're barely starting to get above that 50, which the market would have to do to have a continuation of a strong bullish move. If I move it down to the daily, the 200 did not gain momentum on this final few days of strong rally. The 20 just barely starts to cross it, and I'm sure it's going to halt and go down. The 50 is likely to start to go flat or turn lower if we see a continued downside. So right now, we may see that the 50 gets as close as it can to that 200 before finishing this B wave and then turning lower. So very much not very committed, let's say. Over in the Nasdaq, if I can put up the right letters, it's really the same story. But here, a little bit different. On the logjam, that's more the SPX. It's not necessarily the NDX, but it's kind of building. But it failed in terms of this bar needed to be red. It needed to be a down bar. And they managed to close the day above the low produced. And that keeps us in a little bit of an upside mode. Now, what we're doing, same deal. Changing that B wave to an X wave, marking what was in intermediate wave 1 as intermediate wave A. So the actual mechanics of the B wave are exactly the same as a wave 2. We give it a little bit more room to the upside, but it had it before. The Nasdaq continues to, or to show that the high that we created on Thursday at 12,880 remains firmly, 881 remains firmly in place. That was above 12,900 on the futures market. So this Friday candle is not necessarily bearish, although it had closed lower, would have produced a bearish engulfing. So this whole concept of the logjam is still there because we spiked, right? It was just a little island formation, maybe. I don't know. If we get another update and it's all by itself, it could set the stage for a severe drop, a quick start to the next move. So I still am leaving it open in terms of the internals of the minor C wave, of an intermediate B wave that are open. So we have 1, 2, 3, 4. We're in that fifth. I have to leave open the fact that we maybe have one more little shot. So let's fill in some blanks there. First thing I'll do, and I'm just going to measure out wave A. And that is set up the way it is because of the line chart. I also did a lot on using the line chart across the board. You can see. So I'm using because we trade off of the candlesticks, I'm using the candlestick chart, which shows that high being there. So it might be a slight difference, but here we are. We've gotten above 1.236. The 100 we gapped above, and now we have the 1.236, which we've reached above, came back down, tested on Friday, and failed. Those are important clues. So we got to let the market tell us, but we're leaving open the potential. What's left? A move above 12,900 for the cash market. Next stronger resistance comes in at 13,056. And then we have 13,468 if this B wave tends to be flat. So could it flip and turn into an irregular? Well, yeah, I guess it can, but in its current position, I would find it very strange because it's just going above an X wave. And it's a double ABC, and it likely shouldn't. So I'm actually considering in the Nasdaq that possibility is pretty low for me. Doesn't mean it can't happen, but it is pretty low. So now one more that I want to add in, and that's just going to be the retracements. So we're going to fill in that gap to see what we can find if we have some additional resistance. And again, here we have it. So we have that right there at that same level, which it tried to get above and failed. So our next level within just retracements is again up here at 13,720. And it's actually a little bit lower. So the top, and that would then produce a perfect flat. So once we get above all this, we start getting up here, it's going to be a flat. And then we should still get our C wave down. I don't necessarily want to see it above the top of what I'm marking as wave X. Now, I am going to take those off. And so we can take a look at what some of these internals are looking like on our daily chart. And again, if I break this down and I bring it down to the daily chart, it's the same story. We gapped, so we got this big island sitting here. We came down after the number. We raced up We came back down and closed slightly back right at the hourly 20. Now, the numbers are the numbers, folks. The unemployment is the employment situation numbers. They can't be taken back. They can't change. That's what was reported. So reality is reality. No matter what the market decides it wants to do in a few of these stocks, pushing and getting things the way that they desire, it's not going to trump the reality. So I do expect the market to begin a C wave down, which is going to carry the same characteristics of a third wave. I've talked about it before. And that we get our larger picture back in alignment and drop to levels that we need to see. Moving average wise, we can see here on the 4-hour chart, again in the cash market, that 50, very strong, very strong. That 20, very strong. That's a 4-hour chart. This thing's going to have to come off way more than it did initially after that number to break this bank. So here in the Nasdaq cash on the 4-hour, it is an alignment to go up. If I move out to the daily, it's changing just a little bit. We still haven't gotten above the 20. So again, short term, again, the possibilities are there on the daily, but not as clear and clean as here. But if we start to break down, this will all stop. This will go flat. This will go flat, and these will start to turn. Okay, now getting ourselves over into the bond market. The 30-year bond presents us with a very interesting picture because I continue to count this. First, let me just kind of go out here so I can tell you what we ended up doing. We, again, now for this month, are sitting right at that 3.60 area. We've been there since basically the first week of January, which I somehow didn't include here, and I should. We've been sitting around 3.60, 361, 366, 64, and on Friday, we got to 363. Now, the bond and the 30-year bond has been incredibly volatile, and you can see it right here. Now, what we are counting in terms of bond price is that the bond market has done 5 waves down, right? I've labeled them. And again, I'm going on the line chart, which takes out that extreme and puts our high right here, which is where the lowest interest rate was also recorded at 1.17. And that was in July of 2020. So I marked that as the high. And now we start and have completed what I'm labeling as an intermediate wave A, down at that low, which was 4.40%. That was the interest rate. Now, bringing this down, what that then suggests, actually, I think we just need our daily chart. What that does suggest, and again, I'm going to keep it on the close basis. If I can put it over here, and we're going to see the same, oops, put it over here, and we'll see the same types of moves, but it can be a lot clearer to see when we're putting it on the line chart. So again, 5 waves down. We're now going to do an ABC counter trend rally in the bonds. So that's going to consist of an ABC. It's going to be an intermediate degree, the way I've got it labeled, but it's still going to be a B wave. That's going to consist of a 3-leg minor degree A, B, and C. So we've been tangling with or the market's been tangling with what are we doing in here, and are we going to go up, continuing what the ABC would look like, or are we not finished with this internal B wave? And that seems to be the case, because every time we've tried to get up, and trust me, when I put it back over on the candle chart, it was breaking above this high. It did it once, twice, 3 times, but it failed every single time. B waves can do that. So in essence, I'm now looking at this as 5 waves down, which could be A of B, 3 legs up could be of B, and now we're going to do another 5 down. And what that does signal is it gives a strong potential that we could drop back down closer to 118. But now let's start putting in where where this B wave could get. First of all, we need to just put our retracements in, and we're going to retrace from there up to that high. And now we have them. So you can see we have, this is 124.11, basically that low, and we're right in between. So that's actually support. And it could produce a flat ABC labeled B. So that remains important level. But then below it, we have 123.08, 121.30. And then we have our bottom, if it wants to be on the larger scale, an ABC flat. So we still have these possibilities. Remember, corrective waves, they can be quite nasty to try to figure out because there are basically 13 different variations within the flat family of corrective structures. So we have to consider everything. Yep, it can drop all the way back down to here, which puts our interest rates back at like 4.5 or thereabouts, and still rally back up to what we've been seeing now, 3.6, 3.5%. And still, it's just going to play in there as the larger picture works itself out as far as interest rates are concerned. So right now, the reaction we got in the bond market on Friday was more in line with what the market's now expecting. The market is expecting additional rate hikes, and they're not going to be expecting them at the clip of 25 basis points. So I think the market is now pricing back in 75 basis points. And I think what the market was doing on Friday was factoring in the possibility that the Fed will make a move between meetings. That's how strong that number was. It blows their whole plan out of the water, so to speak. This whole thing about, we're in control. We're seeing signs of inflation, lessening, decreasing, et cetera, et cetera. And then you get a number like that, which basically just blows the whole thing right out of the water. They need to get more aggressive. They need to be aggressive. They need to remain aggressive. And that's what this bond market is telling us. They get it. Equities might take them a little bit longer. So in the 30, we now need to consider that we're going to go down first before we resume this larger intermediate B wave counter trend rally. That still has the same fibs. That still would tell me that once we can get ourselves above the daily 200 EMA, which still sits at 133, now it's 133.10, it needs to get above there. And if it can, we should get a strong push. Now, if it does it now, I'm going to be like, well, what the heck was all of this? But because it necessarily doesn't fit cleanly. And the fact that I can count 5 down basically, or actually A, B, and this is 1, 2, it doesn't work. It counts best as 5 down, A, and this is a B, and now we come down in a C. Minimal, because it's a perfect, beautiful little flat. We're going to get ourselves back down towards 124, 124.11. Maybe drift a little bit below that, and then start to rally again. And where was this level? If we're thinking this was the end of the year, let me go back out here. 4%, 3.97, 4%. That's where we're heading back to, possibly, before we take a really strong rally to get ourselves back above those levels that I've just been talking about. So back onto this. Actually, I can go back onto this. We have, well, it was the daily chart. Let me just put up the one I was working on. Sorry. We're going to come down. That's a very strong possibility down here to within here. And that on a push to the downside, I believe should contain an internal B wave, set the stage for us to go back and resume this counter trend rally. That's still out there. Now that fits very, very cleanly with the equity markets putting in a C wave down, which only going to take us just below 3,500 in the SPX and just below the mid-December lows that we saw in the Nasdaq. So it's higher rates. It's going to shake up the market. They're going to make a bigger correction, since this whole rally phase that we're witnessing was, the premise was they're going to pivot. They're going to lessen the rate that they raise these rates. So that could change, and that's going to change how far they'll take things down. Now, over in the 10-year note, it truly, all of them are putting in pretty much the same thing. Let's start here by taking a quick review of where we were and what we did on Friday. So here again, we can see that we basically, for the month of January, and now starting in February, hanging around 3.5. But now we're heading a little bit higher. We're pushing a little bit higher. This was a very strong move in the 10-year as well. Closed up slightly off of its low, but it did put in a pretty, and produced a bearish candle on the monthly chart that it kind of starts to make a presentation. Now here, this produced a much different scenario. Here we do have what appears to be a clean A, and I'm going to take this over to that line chart, same deal. With that, we did get what I feel is a clean B wave. Now, unless this is going to be marked as an irregular B, because it moved up above the high, not a whole lot, but it did move up above that high, and then this turns into a C wave. So if this is going to be A internal, right, that this B would get marked over here. That's A, this would be a B, and now we're coming down in a C. But even this, there's 3 waves down, starting up higher. So it really gave a lot of indications that it was going to continue to move. And that would throw a wrench if the 10-year goes off by itself. So sort of like heading towards the low or the short end of the curve, that it continues to move higher in respect to the counter trend rally. Now, I don't necessarily see that, but here are the levels going up on that deal. So what I'm going to do is I'm going to take that out, and what I want to put up is that if I need to say 1, 2, and this is 3, and this is 4, 4 did not overlap wave 1, and then we have wave 5, and if I have to move the A, right, this would be the change. And I waited to do it so that we could all see it. If I have to move that over to there, and this B wave is still in progress. All right, I just showed you why I would leave it, but I'm now going to move it, and I'm doing it together so we all can see it. That we have the 1, 2, 3, 4, 5. That's the wave A of an intermediate B wave, and then we're doing the wave B. So if we need to measure, where can we go? Let me just go back over to, so I can include, I do like to include the extremes. So now we're just going to put in what we have just as retracements. If we just have retracements, you can see, there we go. We're going to huddle around the lows that we saw at the end of the year. And that would be right around 111.28. 111.28 was that low. And then we have 111.21 as 618 support. So we could see a stronger downswing here in the 10-year develop and come through and pushing us back to here. Downside, 111. And that's going to push us closer to, if we take a look back on that 30, where were we at the December mark? We were up around almost back at 4%. So again, all of the bonds at the long end of the curve tend to bounce around from 3.5 to 4. The 30 got a little bit higher. But here at the end of December, we were just under 4%. and that's going to be down here. So I don't necessarily see that that's going to be where we head right now. I mean, it could. It doesn't have to, but it could. I actually think these are going to be the areas we'll get that B wave in, and they'll resume their counter trend rally, putting in, and that would be putting in a minor C wave up, and that C wave will be 5 waves. So again, we're going to still be in the box that's been created the month of January. Now will last us probably through the month of February as well. So again, over in the, that's the 2-year. So I'll just go over the 2-year, and then I will get to the 5-year in a second here. The 2-year note, they're hovering around all above 4%, right? Because the short end of the curve has not really cut and come way down. So here again, we've got the 5 down. We're in an A wave, and I'm going to slip over to there. And same deal. Look at this. A lot of just bouncing. This is more in line with actually the 30-year. Just trying to find, where do we belong? Where's our pricing? So if we're here, if I feel like 1, 2, 3, 4, 5, A, B, could be a slight new high, but it should be a B. And then we get a 1, 2. Now we're in the 3rd. We likely start to end up back around 102. Now, if I just had to think about where are we and what can we do on the daily, I'm going to put in some fibs, and that's actually just going to go to here, because that's the high of A, and this would be the high of B, which on a closing basis is a big old flat. So on the 2-year note, we actually could find our support to complete this little C wave at 102. So where do we hang out? We're still going to hang around 4%, plus or minus 4%. That's where we are, down closer to 4%, up above to like 4 1/4, 4.5. So we're still going to be in that range. The 2 is going to be taking a lot more to really start to push lower again, and I'm not suspecting that before we get up and finish that intermediate B wave counter trend rally. Then lastly here, we got the 5-year, which again, also middle of the road, but same deal. I got the A wave up here. We're doing a B wave coming in. If we take just to put in our retracements, we are looking again. That was the low at 107.18, and we got 107.12 at 618. Very clean for a B wave. Very clean. Remember, B waves 50 to 60, 50% to 62. There it is. Hits it on the nose. That also could be flat and come to here. I would expect it maybe to get down to here. If on a real push, 106.30. Then we're in a B wave, and then we get that C wave up. And then we're looking at putting in extensions, but we're looking at getting back up towards, 12, 13, 14, 114. So to get up into this zone. So even the 5-year, everybody's kind of hugging, everybody's sitting around levels that we've now seen all month. Here we have, sitting just below 4%. Ultimately, we're looking for that low or yield high to be taken out. So when this ABC, when the B wave is done and we resume an additional 5 waves down of intermediate degree, it's going to be intermediate C wave. I would be looking for it to take that out. Okay, so now I'm going to go over to gold. So interest rates, yep, they're reacting and pretty much following pattern now. Gold, monthly chart has not changed. So I'm going to go straight down to this daily chart and get right to the meat. That Friday's reaction here in gold was a massive surprise to me. I was like, oh my word, what are we doing? So I went back. Now I wanted to start with actually silver, because if you remember, as I've been talking about silver, I've been really talking about how, boy, this thing is not rallying. Boy, this thing is really turning into a mess. And even if I go back out and I look at a weekly chart, I had labeled this as intermediate wave 2, which put us in an intermediate 3rd wave. That I'm looking at it going like, wow, you're not done with that intermediate wave two. Because remember I said this is just not bullish. And this was not pulling in a bullish. Guess what? A, B, C. It's an X wave. That's how I'm going to label it now. And that opens the door for another ABC. So what is this whole intermediate wave two? Yep, you guessed it, WXY. So here again, in my book, a double ABC. And if that's just the completion of the first, and here's the X wave, silver has got a ways to go before it's going to produce a strong rally. Now, what that's not going to stop them if they decide to turn and go at it. The count would change. This is on the weekly basis. If I bring it down to the daily, we're on a little bit stronger start. We're heading for the daily 200. A break below should kick the momentum out of a bull run. Breaking below the 200 will signal no, that's not likely to happen. We are now seeing that the 20, the 4, and the 8 have all turned lower. The 50 has turned flat and wants to go lower with it. This has gone flat. So the precious metals are beginning to basically tell me you might be in a little bit of a hurry, and labeling that the stronger rally was back on. That doesn't mean it's not going to happen, folks. But trust me, that doesn't mean that at all. And so here in silver, I'm thinking that we've got potential for another little bit of a slide. My first take on this is going to be, we're going to look for what this could look like. Let's just put straight fibs in here. And, you know, we're looking like silver could, if it's going to come down and break, it's going to break below that. I can go up back to my weekly chart, and we can really come down. I had this before. I'm not sure. I will figure it out and give it during the week. But I'm looking here just on straight fibs, retracements. If it sticks within inside of this initial X wave, we're looking still. We have the potential to come down here. If I'm going to just put it in for what this second ABC might look like, I'm going to get rid of that. I'll go from here. Let's put in extensions. These are just from that high to that low to that high. So we're sitting that it can drop back below 17 and maybe as low as 14. Now that would be pretty damaging for silver, but we can't ignore the possibility. So those are the numbers. If you are collecting silver, if you are long the future, you can protect your position by adding to it, but also by putting puts underneath it, or buying puts and then selling calls to kind of pay for the puts. There are different things that you can do to protect a position that you may be building over the longer term against these drops in between rallies. So that's silver. Over in gold, that's silver gave me the initiative to think, wow. And again, I am using the line chart. Granted, we got higher levels, particularly here. It did go above 2000. In fact, it went to 2079, and like this was 89, that was 79, still a B wave. So I'm taking it off of there, and just because it seems to put a little bit more realistic spin on it for me, that the high here was 75, but the close on a closing basis 52. So, but what it does signal though, folks, is that there's a potential for gold to drop back below to 1600. And so there's one member of my trade room that he and I talk gold all the time, and he was mentioning what was the potential that the market could break back below. There was a gap somewhere and come back down towards 1625. And I thought, I don't really see that. And now I must confess and say, now it is possible. because initially I'm thinking this was going to be a stronger rally, and our next step was above 2000, and it certainly appeared that way at 1975. And we get bang, bang. What's happening to the dollar? Bang. What's happening to the euro? Bang. What's happening to interest rates? Bang, bang, bang. And they, between 2 days, they dumped the gold futures $100. So what we have here is the potential to come down. We're starting to see our moving averages agree. If I look at the daily, daily's even pretty strong. Our first support basically was reached on Friday. I'm pretty sure that the low was, it might have been an extreme low, but a low nonetheless. This is 74.50. I think it was I thought it was a little bit lower, but we have support at 1869. Then we have the 50 at 1850. Then we have the 3.382 at 1818. We have 1776. I like all these numbers. And then 1800. So we do have support coming off, but we have to consider the full potential of the move. If this is an X, I'm looking for another ABC. And it's going to take some time. So we'll see. Again, that's just a preliminary, giving me an idea of what we might be expecting here. And I'm just going to try to follow it and then make changes when necessary. But for right now, it does appear, unless gold turns and decides nope, and it goes back up $100 to keep this all in place, because the only other choice I have is at 1, 2, 3, and this is a 4. And yep, fourth waves, particularly in a commodity, particularly in precious metal, can look just like that. But what happens is it stops, it doesn't go very far, and turns right around and puts in the next move up, and then again has to go to new highs above 1975. So those are our choices, but we'll keep an eye on gold. And again, if you trade gold, if you're building position in gold, there are ways to protect your positions. There are ways to, you don't have to sit and suffer through moves like this. If your choice is to hang on to the gold, well, you can protect. And then finally, let's go over and take a look at that dollar index. Strange things in the dollar index as well, but I was able to open this thing up and take a look at what I think is happening on a little bit longer term basis. So I upped this to intermediate degree, and I'm labeling it as such because that's the color code I use. And that puts this whole move, all of this jumble, into, again, a double ABC. Now, the double ABC is a double ABC up. There's wave A. We're in the B wave down, and then likely we'll have a C wave back up. So we're in the down cycle of it, the down portion of it. Now I'm on the monthly chart. So this is going to take a lot more time. If I bring it down, if that top there is wave A, then this is the beginning stages of the internal B wave. Now this could be all of it. If I look at it, right, that could be A, B, and then we got a 1, 2, and this all works into a 3, and that's a 4. And then we're coming off in a 5, and now we're going to start. So this could be an ABC for wave A. It could be 1, 2, 3, 4, 5 for wave A of B. And then we get a B wave. So if I just take straight fibs and looking at what the dollar can do, now remember, right? The metal's reacting to the number and interest rates. The interest rates reacting to the number. The dollar reacting to that number, to interest rates, to et cetera, et cetera. If the bonds are going to start declining, pushing the yields higher, then the dollar's going to go up, because I'm going to give the dollars to wherever they're going to start giving me more interest, right? So I'm going to need my dollars. But what do we have in terms of where can this B wave, and it's going to be an internal B wave, if this is only wave A of a B, it suggests that we go up and we're going to come back down, and we're still going to end up here before we do, again, a larger rally. Now, where can the B wave take us? 104, 105, 106. That's 382. If it really gets extended, then we're looking at 107, 108, 109. These are levels. All right. So first up, 104. We got back above 102, got close to 103, which is quite the strength that the dollar was showing on Friday. It was up over 100 basis points. That's a pretty strong move for the dollar index. So again, are we going to start to see this squeeze flip and go here as all the dollar shorts start to get squeezed? And they got to come in and they got to start reversing, got to start changing. We're going to see a lot happening within the Forex markets, I believe. So again, we're into that shift where things start to really change and move around very strongly. All right, so dollar, we got the ABC. That's what I'm looking for. We've got our levels. Let's see how it all pans out. Let's see what happens. Things can change more dramatically now. And again, folks, the confusion and what's really going on, it totally can wrap itself around that the markets are in corrections. They're, no matter what, I don't care what the direction is, it's a correction of one direction or the other. And when we get into a correction, there are basically between 11 and 13 different patterns that the market can be tracing out to fulfill that correction. That produces a lot of confusion. That produces a lot of what's going on between the markets, because we'd be looking for the dollar to be moving in accordance with what the perception of interest rates is going to be. And then we're looking for gold to do the same. We're looking for equity markets to do the same. So again, pecking order, right? What do I have? Interest rates up at the top. So whatever happens in interest rates is going to filter down through the balance of our areas, right? Forex, equities, treasuries. It all kind of flows through and comes down. So if we're looking that the interest rates are going to start to get hiked, well, I'm going to look for a higher dollar. I'm going to look for gold to react negatively. I'm going to look for the equity markets to react negatively. So again, that now fits in the count. So if everything works together for the greater good of the markets, then we're going to see higher rates, again, sitting at the top of that food chain. And when that being in the case, then I'm going to start to look for that the prices in the individual markets are going to react accordingly. So here in the dollar, I'd be looking for a move up. Doesn't mean that's going to happen every day. Doesn't mean it's going to be a straight line, although we had 2 days of pretty strong gains. So I would think coming off of that low, that's what we're going to see again. Just some strong gains, get up here, futz around, put in a B wave, and then come up and do the C wave, and then we're done. Tell me, if we get all the way back up here, the equity markets will be dying. You know that because we watched it before. Why would we think that this time's going to be different? So again, connectivity. What's happening in one flows over and produces a reaction in the others. And this is where I'm going to conclude. This is where I'm going to end it. Sorry that I'm putting it up on Sunday again, but nonetheless, I did get it put together. Here we are. There are some changes. I think that they're clarifying changes. So our next big picture update will be next Sunday on February the 12th. And later today, I will be making a quick update on the S&P 500 and the Nasdaq 100 in an Elliott wave update once the Globex gets started again later this afternoon. Have a great week, everybody.